Hello, my name is Matthew Granger and this is the FCTO weekly review and outlook for the week of June the 18th, 2012. The situation got a bit complicated just ahead of the crucial Greek elections. On the one hand, news flows from Europe was generally negative, with soaring peripheral yields and downgrades. On the other hand, risk markets were lifted by speculation of additional stimulus from central banks and coordinated actions by G20 leaders. It's reported that G20 leaders, who will meet in Mexico on Monday and Tuesday, were already preparing for coordinated action to provide liquidity if global financial markets worsen markedly after the Greek election. Indeed, the Bank of England has taken the lead and announced credit easing measures, and the European Central Bank seems to be opening its doors for a rate cut. While investors should be in deep worry of the Greece situation and the need for the bailout of Spain and Italy, stocks jumped, with the stock Europe 600 index rising nearly 1%, and the S&P 500 just had the first back-to-back weekly gain since April. The dollar did weaken, with the dollar index back below the 81 level. It's strange that investors were worried and were buying at the same time, and it even feels a bit like investors were hoping for the worst outcome for Greece so that central banks and officials would then have enough drive to do something drastic. It's meaningless to speculate on the result of the Greece election, as the pro-bailout New Democracy and the anti-austerity party Syriza are so close in this election. Let's just wait and see. But we'd like to point out that Greece staying in the euro isn't euro positive, as the problem will certainly drag on, and likewise Greece's exit won't do any help to the euro either. The point is not on the euro, but who will gain the most against the euro. If Syriza win and the financial markets show drastic reactions on Monday, sterling will likely gain on safe haven flow, while the Aussie would likely regain strength after world leaders announce some strong measures to calm markets from panic. If New Democracy wins and Greece stays, risk markets could then have a pullback as world leaders would keep the bullets in the pockets first. Also, if it's as inconclusive as before, worldwide leaders would likely to hold their hands. In such cases, the sterling and the Aussie could first retreat against the euro before developments in Spain and Italy send the respective euro cross lower again. The outlook of the dollar will remain mixed throughout, as it's not the market driver for the moment. So it's a matter of selling euro sterling and euro Aussie right after the election, or wait a little while for recovery to sell. To recap the situation in Europe, Spanish Finance Minister Luis de Guindos announced that the country would request financial assistance from the EU for recapitalisation of the Spanish banking system. While the final amount would be released after the results of 2 independent audits due on June the 21st, the sum is estimated to be €100 billion to cover estimated capital requirements and an additional safety margin. The announcement didn't restore any confidence from markets, as Spanish bond yield breached the 7% level and made a euro-era record. Moody's downgraded credit rating of Spain by 3 notches to Baa3 from A3, as the bailout fund would raise the country's debt burden and it would rather be a sign of weakness instead of a sign of strength. Last week, another rating agency, Fitch, slashed Spain's sovereign credit rating by 3 notches to BBB. Fitch Ratings Managing Director Ed Parker even warned that Spain could miss the deficit by a substantial margin next year. Also, Parker said that if they see further worsening or more general intensification of the Eurozone crisis, then further negative news could lead to further negative rating action. A US independent rating agency, Egan-Jones, warned that Spain and Italy could need a full-scale bailout within 6 months. Founding partner and President Sean Egan said that it makes little sense to separate the bank's credit quality from the government's credit quality. He predicted that Spain will be back at the table and asking for more than the 100 billion euros that it sought. Meanwhile, Egan also noted that the combined economies in the EU have fairly high debt to GDP, and the assumption that Germany will be able to pull may need to be re-examined. ECB President Draghi said that providing liquidity is what the bank has done throughout the crisis, faithful to the mandate of maintaining price stability over the medium term, and he pledged to continue to supply liquidity to solve banks where needed. Meanwhile, Draghi also noted serious downside risks in the Eurozone, with heightened uncertainty, and inflation expectations were well anchored, and there is no inflation risk in any Eurozone country. Overall, the comments indicated that Draghi is starting to pave way for a rate cut and additional liquidity support. And it's been speculated that if the Greece situation worsens, the ECB could cut rate by more than 25 base points in July and could probably add another round of long-term refinancing operations. In its biannual financial stability review, the ECB urged that it's now necessary to go beyond monetary union and conceive a banking union as an integral part. 3 important objectives were identified, including banking sector supervision, a European deposit guarantee scheme, and contribution of financial industrial towards stability. The ECB emphasised the need to tackle the root causes of the debt crisis and urged comprehensive response from officials to end a spiral of systematic risk augmentations. Nonetheless, the ECB also noted key risks to financial stability, including aggregation of debt crisis, lower bank profitability on a weak economy, and excessive pace of deleveraging. In the US, economic data released in recent weeks raised the chances of additional easing from the central bank. The US economic indicators released were disappointing. Initial jobless claims surprisingly rose by 6,000 to 386,000 in the week ending June the 9th. Inflation moderated further, with the May Consumer Price Index rising 1.7%, following a 2.3% gain a month ago. The core reading stayed unchanged at 2.3% during the month. Industrial production unexpectedly contracted by 0.1% in May, following a 1.1% gain in the month before. The Empire State Manufacturing Index shrunk markedly to 2.3 in June from 17.1 in May. This sent a signal that the ISM Manufacturing Index for this month would worsen. Moreover, the University of Michigan Index showed that confidence fell to 74.1 in June from 79.3 in May. The upcoming Federal Open Market Committee meeting will catch a lot of attention as policymakers may decide whether to adopt more unconventional stimulus to bolster the economic growth. It is unlikely for the Fed to act this month. Besides the situation that recent deterioration in US data has not reached a level that triggers an immediate move, policymakers would prefer to wait after the Greek election and expiry of the Operation Twist. In the UK, the Treasury and the Central Bank stepped up measures in an attempt to loosen the credit and financial markets. Over the next few weeks, the government will launch a scheme to stimulate bank lending by offering to loan bank funds at below market rates for a period of 3 to 4 years. The Bank of England will also activate the extended collateral term repo facility, which provides 6 months liquidity against a wide range of collateral. Moreover, Governor Mervyn King stated that the other effect of the euro area crisis has been to create a large black cloud of uncertainty hanging over not only the euro area but our economy too, and indeed the world economy as a whole, with signs of deterioration in the outlook, especially in world markets. the case for further monetary easing is growing. This signalled further asset purchases would probably be announced at the upcoming Bank of England meetings. The Bank of Japan left rates unchanged at 0 to 0.1% during a unanimous vote as widely expected. The size of the asset purchase program was also maintained at 70 trillion yen. The central bank noted some nervousness in the global financial markets due to European debt crisis, and it pledged to do its utmost to ensure the stability of Japan's financial system. Domestically, it said that the economy has started picking up moderately as domestic demand remains firm, mainly supported by reconstruction-related demand. Assessment of exports and productions was also upgraded and are seen as key factors to assess the local economy. The Swiss National Bank announced to leave the target range for the 3-month London interbank offered rate unchanged at 0 to 0.25%. The central bank also reiterated to maintain the minimum exchange rate of 1.2 Swiss francs per euro and will enforce it with the utmost determination. Policymakers viewed that Switzerland's economy remained exceptionally high and warned that the current level of the Swiss franc remained too high. The SNB pledged to take any measures to defend the euro-Swiss franc floor. And finally, the Reserve Bank of New Zealand left the official cash rate unchanged at 2.5% in June, although it noted that New Zealand's economy has weakened a little since the March monetary policy statement. The central bank has postponed its first rate hike from late this year to next, but the overall interest rate track is just slightly lower. GDP growth forecasts were lowered this year and as an average over the coming 3 years. Concerning future monetary policy outlook, we believe the Reserve Bank of New Zealand would keep the door open for further easing if the macroeconomic situation deteriorates further. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.